Hi everyone, today is May 23rd and a very busy week in the United States. I am Ms. Schneider, Chief Strategist of MarketGauge.com, and I want to bring you a little bit of a backdrop and then we'll go specifics into some of the commodities and the dollar and the oils. So I think this tells the whole story right here in terms of will they or will they not solve the debt ceiling crisis? Will the Fed continue to be aggressive and what have you? We've been talking about this as a scenario of stagflation and trading ranges, and I don't think it could be put any better than looking at the SPY chart, which right now on a daily basis you can see ran into the resistance at the Bollinger Band after having an inside day yesterday, is now breaking down, which does definitely look like we could see another move maybe to test around the 410 level, supported by this 2-year moving average, or the 23-month just shy of 2-year moving average, which has been extremely reliable as far as telling us exactly what's happening. We are at the top of a range. Whether or not we break down under the middle of the range remains to be seen. And of course, where could we potentially stop? To me, it would be more around the 6 or 7 year business cycle, or around that 320 or 3200 level if you're looking at SPX. But you cannot really look at the whole picture. Obviously, NASDAQ has done well on the backs of all the growth stocks. I think a lot of those right now are in a situation where profit taking should be coming into play, and obviously nothing's going to be impervious to bad news. Of course, from my aspect, I do believe that they will come to some agreement. They just, being who they are, love the drama of it all and want people to pick sides. I mean, that's just as easy as it gets here in terms of politics in the U.S. But we have to look at the small caps. So look, they stopped right at the 200-day moving average. Momentum-wise, they've gotten right to the top of the Bollinger Band, and we actually have seen a bit of a bullish divergence in that the momentum has the 200 above the 50 and the momentum above, where the price is above the 50 but not above the 200. But look at the difference here on that 23-month moving average I was just telling you about, where we saw the SPY get up right to the top of it. In this case, it would be around 198 for the small caps. It's really sitting here right on that 6 to 8 year business cycle or 80-month moving average, which this, along with retail, as seen through the lens of XRT, is telling us that if we cannot play nice here with all of the factors that be, and we start to break down, particularly in May on a monthly basis, under this 80-month, both here and in the consumer area, then those calls for recession can certainly turn out to be true. So moving right into the dollar, we can see that there's been, and we've talked about this, a little bit of a flight to safety to the US dollar against all of the other currencies. And it really was pretty evidence about the dollar breaking out, not only because I had shown you once before that its 23-month was respected at 100.7, but that this was breaking out over this 50-day moving average, which clearly it's doing. And we mentioned that if it got through 103, it could get to 105. Now, where would I change my mind? If I were looking at this from a longer or even a day to a couple of days perspective, I would say right now the momentum is in the favor of the dollar going higher, but just looking at the dollar purely from the dollar's sake, it's telling us it wants to go higher. I would say I would agree with that unless it breaks down under 103. Then I think we would have to take another look at a move back down to the 50-day moving average. And of course, under 100.70, to me, that would not be a very good sign. If we hold up here and get through these most recent highs that we're seeing here, which is in this case would be 103.60, then I think you really have to start looking at this 200-day moving average as a potential target, maybe a little bit shy of it, but figure around 105 much. So let's move immediately on to energy, particularly looking at West Texas Intermediate crude. And we had talked about Brent in the past, but if we look at this, we had very similar patterns in that we had a new low, reversal pattern confirmed the next day. We've been chopping around, but we've really held that 70 level, 70-ish, 69.80 to 70, which again tells me that right now the direction for oil looks to be higher. And there was some threat this morning about the Saudis that come out and said, oh yeah, well, you shouldn't be short oil, whatever that means. But what it means to me right now is that if we can get over this 50-day moving average just a little bit higher, let's call it 74.50, at least for a day or two, that would actually confirm a move from a bearish phase to a recuperation phase, and also would confirm that perhaps we have had some kind of bottom in place, and I would follow that, looking for at least a move up to around 77. And I would have my stop very immediately back under that 50 if it fails. It's really that simple. Buy it on a breakout over a major moving average phase change. If you're wrong, you know right away because it closes back under that 50. On the flip side, if it cannot get to the 50-day moving average and starts to roll down, I would say you have a pretty good pivotal point here, somewhere around this 70 level. Let's call it 70. So in between 70 and 74.50 right now could be choppy, very short-term kind of trade, but under 70, then I think it would probably be in line with no debt ceiling, IWM breaking down, SPY getting closer to 400, and all of that happening at once because the U.S. would start to embrace for that recession. Let's move on quickly to natural gas. So if this isn't the great example of what I just told you, which is something breaks out over the 50, you get a little bit of follow through, and then whammo, the next day it starts to sell off. If I were buying up when this broke out, if I was day trading, I might have taken a little bit of a profit because you would have had a little bit of money, like 20 cents, which is 10% on a $2 instrument. But on the other hand, even if that didn't occur and I didn't get out and I was kind of holding it, it would have been time to get out once it broke down under the 50. And here we are, back under that 50-day moving average. So again, I think that this is an instrument I prefer not to touch, but if you really do want to be a trader, let's say of the July contract of natural gas, now you really need to see what happens back at that 240 level, which it looks like it's going to head to. If it holds 240, starts flipping back around, gets back through the 50-day moving average, once again, it could probably show that it is fatigue on the sell side. This is a really good reversal. But of course, at that point now, it would have to prove more to us by getting through this 280. And then, like I said, maybe we get a move up closer to 3 and then 350, which would actually be a really decent move, again, for something that is such a cheap instrument. Okay, let's go on now to a couple of other things that I think are merit watching. So gold is highly technical, but also very much a factor in when you're dealing with irrational minds, let's put it that way. So at this point right now, we're finding support. If you take a look at the low down from this area right here, which was back in March, so those March lows, which are so much have been a factor in the overall stock market, right now is becoming a little bit of a factor here, even in the gold. And we've traded pretty much right on it. So that gives us a nice level, right? So if we take a look at this level right here at 1,950, and so really it's going to be a matter of 1950 holds, we can get back above its 50-day moving average, which it broke down, which really would be conveniently be about 2,000. Great, we'll see a higher move. If this was just a bounce off of the 150 because of fear, but really can't get up past, let's say, 1990, then I would be quick to exit. And of course, if it breaks down under 1950, what does that mean? And to me, that would mean most likely another visit to 1900, possibly even 1880. And just when the public opinion was basically leaving grains for dead, we had talked about the trading range in DBA, so that's something to keep an eye on. That's the ETF for a lot of the commodities. But take a look at here what's happening in corn. Learn to recognize this beautiful reversal pattern when it happens on these future charts. So basically, new 60-plus day low, next day it closes above it, and then you get some follow through. And that's exactly what's happening here with the corn futures. So again, now we've run into a lot of congestion. If you look at the lows here of this whole period of congestion that we had end of April, early May, we're having a little trouble getting through it. But above 580, figure 580, 581, I see no reason why we can't see a trip to 600. And of course, you have to take things in levels here when it comes to these commodities. Look how important that 600 level is, even going back to here. And then, of course, through 600, next area we're going to be looking at would be that 50-day moving average, or around 607, 610. Where would this be wrong at this point? I would use the high of this day, which would be about 541. And if that starts to break down, excuse me, 561, sorry, 561, and under that 561, then I would start to say, well, maybe this was just some quick short covering rally and the grains will work itself lower. Let's take a look at wheat as well. Well, talk about timely. Looking at wheat right now, this is exactly what I just mentioned to you, which is the new 60-plus day low and reversal. However, maybe I would take a modicum of patience here to see if you get follow through. By the time you hear this would be actually tomorrow on the wheat futures. We'll also keep an eye on the volume patterns here. It's still not over as I'm talking to you, but you would like to see some accumulation of volume either today or on the follow through if it gets through today's high tomorrow. And finally, let's take a look at my favorite barometer of all, which of course would be sugar futures. So here again, you have the classic reversal pattern, only you had it in reverse. We saw a new high, it failed, it had an inside day the next day, and then it closed underneath the low of the day it made the new high. Typically, when we see that type of move, we look for about a 5 to 10% move lower. So if you're looking at 10%, basically you're looking at a move to around 24. And that really actually looks very nice technically because that's where your 50-day moving average is coming in. And it almost looked today like sugar was going to start to take off again. But really, when you have these type of reversal patterns, you either want to wait for them to play out against a major technical signal, like what I just mentioned here against the 50 or around 24 cents, or you want to wait for those highs to be taken out. In this case, it would be about 26.80, in which case you know now that it's getting ready for a new leg up. Focused, and just bringing you back to the very beginning, keep your eye on those trading ranges in the monthly charts, particularly in the Russell 2000 small caps and in the S&P 500. That's it for now. Thanks so much.